Hey, I thought I would hop in here. I actually just wanted to. I just tweeted something, and I felt like, hey, I can kind of explain, give a little context to it, um, while I'm sitting here. I'm procrastinating. Let's be honest. So, sorry. All right. I put this tweet up here that the trading version of not being in on the joke is to not know which side of the market is fake on the lean. Kind of wrote a little snarky thing. How many times do you have to watch someone hit their own bid to learn? And uh, I want to back up and talk about like on the in the trading floor for a second. If you were in a pit, uh, what a lean is, or the mark if a market is faded or leaned in one direction, what that's about, and how it happens. So the first thing is, let's say there's an option that's worth the crowd meaning the people in the pit, the option traders in the pit, they think it's worth fair value is 74 cents. Let's just say, and you might say, why does everybody think that option is worth 74 cents? How does everybody have the same value? I'm defining fair value by the idea that a price fair is the price at which you could liquidly buy or sell something, and it's an ephemeral idea, right? It's like just at that one moment. It's just at that moment you could buy or sell. Things could change in the market, and that would no longer be fair value. But right now, at this moment, uh, that option is worth 74 cents, and there's wide consensus around that in the pit because that's the price that one market maker and another market maker might be willing to pair off their risk at that price, which means that neither side necessarily thinks there's any edge in it. They're just trading it for fair. This is a pretty common idea in a trading pit. Like there is a concept of fair, where an option is just trading liquidly at that price. You could buy or sell as much as you want at that price, or at market maker kind of sizes, and the market will take it. That's fair. Okay. I like to sometimes I joke around about that concept, or refer to that concept as like the market is Jane Street by Sig. You have no advantage over this. Like that's one's the bid, one's the offer. You have found fair value. Pretty straightforward. Okay. Now, in a trading pit, there would be times where a market would be leaned one way or the other. So, so in a leaned market, depending on what era you're talking about, if you're talking about the year 2000, an option that's worth 74 cents might be leaned, 90 cents at a buck 10. But as markets get more efficient and all that, those leans get smaller, or the way the leans end up in the marketplace change. But let's just say back when I was on the floor on an IMEX, let's say you got an option that's worth 74 cents, and maybe that option gets quoted, and maybe the market makers make a fair market, or what we'd call a round market. So if it's 74 cents, let's say they're 6 cents wide on a typical market on an outright 50 delta call. So they might make the market 71.77. Okay, 74 is dead in the middle. It's a perfectly round market around fair. So market 71.77, and people, a bunch of people will shout out that market right away when it gets quoted. Fine. What about now? What if somebody in the crowd had a pretty strong sense that there was a large buyer, that the person quoting was a buyer, and that they were a size buyer. So they think 74 is fair, but now that this person's a buyer, right? So now what market might get made? So let's talk about a couple different scenarios. First of all, if a large market maker who is pretty wired about having a very good idea of what that broker is going to do, whether they're going to buy or sell, this could be anything from a matter of sort of pattern recognition to you go out to dinner enough times with people and they leak information and you start to be able to put pictures together, whatever it is. You got some large market maker in the pit that's pretty good at knowing what direction a large order is going to be in. It could be as simple as like just good pattern matching. Like they've seen this customer show up at this time of the month every month. It's some kind of like repetitive type of order flow. It could be something like they remembered, like, hey, I remember when this customer sold a bunch of these options with a month to go or a week to go. Their calls, the market's dropped a bunch. This particular the signature of this order flow is that it likes to close with 1 week to go. So when they come and they quote that option, and I see there's a bunch of open interest there, and maybe I even remembered that they sold this option 22 days ago, and they sold it for $3.50, and now it's roughly around 74 cents. That they're probably a buyer. They're coming back to take their profit. So they'll quote to the big market maker. If the big market maker acts first, makes the first market, yells out the market fastest, they might yell something like 75. Hey, I'm 74. Let's say they want to be 6 cents wide. They might say I'm 74.80. I'm 74.80. If you want large size, I'm 74.85. Something like that, right? So they're leaning the market. They think it's worth 74. They're bidding fair. They could be even more aggressive. Depends how certain they are that the customer is a buyer. Because remember, there's some chance the customer is not a buyer. Like this is an educated guess here, right? If they're completely certain it's a buyer, you might see something like 77.87. They might say I'm 77.87 for size. Okay, now couple things here. If they're the first person to make the market, they might make a market like that. The rest of the pit, they weren't born yesterday. They know the option was worth 74 not 3 minutes ago, and then a big market maker who spoke first makes it 77.87. So they are going to deduce that this market maker knows that this customer is a buyer, and they're going to be like, yeah, I'm on it, 77.87. They're going to join the market. That's how this is going to go. Now, what happens? And we'll talk about some other scenarios. What happens if a big market maker who knows the flow doesn't make the first market? And let's say you have some young whippersnapper that hasn't been around in the pit very long. They're coming over from some, they're coming over from some trading firm, and they're trying to make a name for themselves, and they're really fast because that's how they got to being able to trade this thing. And they come in the market and they say they make a quick market right off the gate, right? It's like, hey, I'm sorry, 71.77. They make the first market, and they make a round market. Now the big market maker sitting there in the crowd that knows this customer is a buyer is now annoyed because this young whippersnapper's market has just destroyed the edge in this trade, because now the buyer is going to get, first of all, the buyer is not going to get filled at 77 because there's no way any of the large liquidity players are going to sell this giant chunk of options for only 3 cents of edge, knowing that it's a size order. So what's going to happen is the scenarios here is that little market maker that was trying to make a name for themselves is that the broker is going to look at them and they're going to say, how many you have at 77? And that broker, that market maker they're going to want to stand up to their offer, and they're going to put a reasonable size on it. Won't be enough to fill the order. And the broker is going to do any number of things could happen here. They could say to the market, they could just lift the market maker and be like, I'll just take your 100 lots or whatever. And then how are you now kind of thing. The other thing they might do is like, that broker's annoyed because like getting filled in like all these little bits and pieces is not going to be like, they might not appreciate having to fill the order this way and then have to start chasing, right? Like, as this is all going down, market makers are out there buying the futures, buying the stock because they know this guy's coming in to buy calls. So they're front running the delta hedge, the whole thing, right? So that broker is going to say, where are you for some size? Like, I don't care about your little 77 offer. Where are you really on this thing? That might signal, okay, this guy's a buyer, and we're going to have to set like, what's the liquidity price here? The other thing might happen, and this is like, this is a little bit of like what I had in mind when I wrote the tweet was a big market maker might just look at the little market maker who made the 77 offer and just be like, I'll take them. And any number of things are going to happen there that are kind of rhyme. First of all, you're like, why is this big market maker going to pay 77? It's because he knows that there's a giant buy order come in. He's willing to lose 3 cents of edge on that buy because he's not interested in trading 100 lots. He's like, I want to sell 1,000 of these things for a dime of edge, so I can make 100 grand on this one print, right? So he's like, by this market maker offering 77s, he screwed up the whole thing. Like, there's not that many orders that come in a day that are like going to be these giant telegraphed orders. He's like, this market maker's like cramping our style. So he's just like, I'm just going to lift you. I'll pay the 77, get out of my way kind of thing. And what might happen there is that little market maker, he's getting lifted by the big market maker, and he might say, I'm only going to sell you 50. I thought you were, you're not a customer, but I'll honor my offer, blah, blah, blah. Like, I'll sell you 50 lots, like just to save face or whatever. And the big market maker might be like, maybe they take the 50. Maybe they're like, look, kid, just next time, shut up. Don't make the first market because you don't know what's going on in here. You don't know the game. So next time, just don't say anything. Like, he's not going to say this. It's going to be all understood that the little market maker is like, oh, when I speak up quickly and I don't know what's going on, I look like an ass because when I open my mouth, I might be getting hit or lifted because I don't know the game going on right here, right? So what ends up happening is, so it doesn't end up, it's not like they didn't coordinate to do this, but you can kind of see how the fact that the big market maker would have been willing to lift the little market maker makes the end result look as if it was all coordinated, right? Even though it's not. It's just that the 74-cent fair value is not a good fair value once there's a buyer of, say 5,000 options. That's no longer fair anymore, right? You can't liquidly buy or sell there because that there's nobody that wants to sell 5,000 options at 74. Okay, so this is what's happening in the pit. There is the smaller market maker. Then the market maker learns. So he's like, okay, I probably shouldn't make the first market when I don't know when I don't have a great read on what the flow is. So over time, this dynamic keeps playing itself, and then the pit ends up making markets that absorb the liquidity sort of correctly. It actually looks a lot like collusion, even though there is no direct collusion. Everybody's sort of competing, but they all are ultimately competing against that customer. Now, there are things that people do in these situations where I've seen stuff where like a market maker may call up a broker and be like, hey, the ring just made this lean this market up 77, 87, right? And so they come out and then they call the broker and tell the broker, hey, go hit the bid, because no market maker, the market 77, 87, people don't want to step out of line and screw the market up if that guy's really a buyer. But what if you thought that that big market maker was legit wrong and that's not really a buyer there, and you really want to sell the 77s because as soon as that broker opens his mouth and reveals that he's not really a buyer, that market is going to be BS. Or that broker knows he's walking into a lean market also because he's not stupid. He's been watching the pit. So if he's paying close attention to value and he's also monitoring fair value, he's like, these guys are setting me up. I'm not gonna bid into that. So I mean, I've literally seen things where the broker comes in and goes 70. He'll come in, you go 77, 87, and the broker will just play like a little game. He'll just be like, I only have a 76-cent limit here. I can only pay 76. Then like market maker will wait for like 10 seconds to pass, and somebody will hit the 76 bid, and the broker will be like, wait a minute, I thought you were 77 bid, and the market maker was just like, the stock moved, whatever. The futures are lower, so I hit your bid. And he's like, futures are lower by a nickel, and you're hitting my bid. That doesn't make sense. You thought, like, I thought on a 77, 87 market that fair would have been 82, and here you are hitting 76s on a 50 delta option when the futures only dropped a nickel. That should only move this thing by 2.5 cents. Like, that means like your real offer was more like 79 and a half, like 79 and a half cents, not really 87 cents. Like, it just doesn't add up, right? And a good broker is going to like understand all that very immediately. So, but whatever, they're going to begrudgingly probably take the fill. But the point is, like, this is the market makers literally just sold through their own bid, or they hit their own bid. And you're like, if you're very new to the pit, you're like, what is going on here? Like, these guys make a 77, 87, and like all of a sudden they're selling 76s. Like, what's going on? It's like, you don't understand the game that's being played right there, but you learn pretty quickly. And that's kind of and to the degree to, so by the way, so I was saying before, like, no market maker is going to hit the other market maker's bid at 77, because what happens is this ends up disincentivizing people from making correct markets. Like, if there's really 5,000 to buy and nobody knew that, and you made the market 70, 72, 77, and then the broker comes in and lifts 500 contracts from the crowd at 77, you're all going to sell your 77s. You're going to have to move your market after that and find the new price. So rather than doing that, they would actually, they know that they'll make more money if they lean it more in the first place, rather than having to play this like game where you get lifted. So in their attempt to maximize, you are not just going to hit another market maker's bid in plain view, because you will disincentivize people from leaning markets when they have information about which way the market should be leaned. So one back channel thing people do sometimes is they would call up a broker and be like, hey, maybe they think that it's not really a buyer and they don't want to miss the chance to sell even 100 contracts at 77. Because remember, that 77 bid, even though the crowd made it 77, 87, that 77 bid is not for any real size. Like, if you tried to go sell the bid, they're going to be like, whatever, futures moved, I'm not really there, blah, blah, blah. They're not going to honor it. So, or they're going to honor small, like a token amount. So what you might do, so what people would do is like give an order to a broker, like, hey, go sell me 500 contracts at 77 or whatever, and try to sell as many as you can on the bid. This was like known as poisoning the well. Like, basically, if you know that a market is leaned and then you go try to hit the market maker's lean, you are disincentivizing the market maker from leaning markets in the future, which in your attempt to like make 3 cents of edge quickly on this one trade, you are making the markets fare up a lot more quickly, and people to not lean markets probably when you would make more money if you lean markets. And that's, honestly, this is like the natural progression of things. It's how markets get more efficient. So I'm not saying like that is that's how things should go, and that's how it becomes natural. That's how markets become more efficient, and then like the markets do become more trustworthy as to like what fair value is. But there are markets that are less transparent, where everything is this cagey cat and mouse game, and you don't like you could make a market especially I remember being a new market maker in like the heating oil and gas options pit. Same thing. Like, I'd make a market quickly. I think I'm making the right market, and like the biggest market maker in the ring is like, how many do you have there? And you're like, oh shit, like this was not the right market. I don't know. I am missing a very large piece of information. So, I kind of learned quickly, like, shut up until I am in this ring long enough and seen enough cycles to understand how the flow operates in this pit. And then I can start making, and then eventually, like my last months, like when I was in that pit, I was one of the larger traders in there, and I was able to make a fast market and more importantly, correct markets, like making the right market for the situation. Anyway, so going back to the tweet, the point of the tweet a little bit was that we're in this world where like you're just looking at that news and the Trump coin going up today, and it's like this whole like and bag pumping and all this stuff, and it's like there's all this stuff going on, like all this bag pumping stuff is people bidding things, creating stories so they can sell. It's all just pump and dump, and in a sense, like when you were on the floor, it was like it was a different way of that sort of showing itself. Here, it's all created by like whether it's like some mix of like propaganda around some meme coin or some momentum kind of, and ultimately like there is a momentum piece. It's like, hey, we're gonna pump this up, and the early buyers are like people that are sort of in on it, understand how this works. I remember reading Nat Eliason's like Crypto Confidential book, and I thought to myself like, oh, this reminds me. I mean, the techniques are different, and the modalities or mediums they're different, but it reminds me of the shenanigans in how pit trading sort of worked. And I was like, you really don't want to be trading this stuff unless you know where you are in the information pecking order. And uh like it, like there's the rug pull that's coming. You don't know, like somebody if you're new to a pit and somebody makes that 77.87 market, and then you go and let's say you sell some 85s, and then you're like on the next market coming out, let's say you made the market first, and you'd be like, so the buyer's done, the buyer pays 85, and then like the next market is being made, they're like, okay, now it's getting quoted again. If you're the naive market maker, maybe you're like, I just sold 85, so they make a new market, and maybe you make your market 82, 88, right? Well, why are you bidding 82? Like that whole market was leaned up. Like not 5 minutes ago, those things were worth 74 with the stock in the same place, the futures in the same place. So like, why are you bidding 82? Like that's so. If you get hit at 82, maybe you're like, all right, I'll buy small, but you got to walk that market back down as fast as you can, right? So it would be a naive to sit there 82 bid and think that fair has actually moved up by a dime in this situation. It may have moved up by a dime, like short run, because like the weakest handed market makers, the least capitalized market makers, they might actually all want to be paying 82 for these, because they're happy to be like, I just flipped 3 cents. But like, in my mind, what these guys did is they made 11 cents of edge on a trade. Let's say we like Bayesian update our fair value by like 3 cents, whatever. So it goes from 74 to 77. They sell 85s. So it's like I made 11 cents on the trade, and they're like, in my mind, like they made 11 cents of edge, and then they like made negative, if new fair is 75, and they buy 82s, and they made negative 7 cents of edge on the close. Like, yeah, you made 3 cents of edge, but you actually made a really negative trade on the second leg, and you should not care about the fact that you made 11 cents on the first leg. That's no reason to go and lose 7 or 8 cents on the second on the buy. Like that's stupid. So like, if you just wait a little bit and let the least capitalized guys buy their stuff back, once the knowledge that these options traded at that price sort of like gets back to all the upstairs traders and like everything. Because remember, like prints on the floor, it happens really fast. And then that information, like all the brokers are going to pick up the phone and call up all their clients and be like, hey, did you see these? These traded like 3 vols up. These traded 85. And then like all the people at the hedge funds and everything are be like, go sell me 1,000 straddles, blah, blah, blah. So you're going to get all these offers coming in for all the people that missed selling those. And like, you don't want to be sitting there like walking it down on yourself. Oh, I'm 82 bid, I'm 80 bid. It's like, no, it's like, hey, I'll buy 80s just to like save face with the original buy. Like if you don't have it, I mean, if it prints 85 and then prints like 75 right after, like that buyer, they're not going to feel very good about their fill. They're going to be like, man, I got ripped off. This thing's traded a dime lower with the stock on the same place, not, 5 minutes later. So they might like, market makers might be like, whatever, I'll buy a couple at 80 to make this, to make the print look good. But like, I'm going to lower my bid really fast. I am not buying from a hedge fund at 80. Like, hey, next bid coming out is like, I'm 74 bid. Maybe I'm 75 bid, because I'd be willing to buy back all my Vega from these guys, and those hedge fund guys, they're gonna offer 77s or 78s or something like that, but but because they missed the first print, and they realize like, oh, I don't have time place advantage, so it's reasonable that I'm not going to make a dime on these, but maybe I can pull a nickel out of this. So anyway, just kind of like a little bit of an explanation of how trading on the floor kind of worked, and like how you learn really, really quickly what like the good side and the bad side of various trades are when you're in it. And by the way, all these products that like advertise how they roll and all this stuff, like now the game is different, right? Because the fade doesn't happen all in like 3 seconds like it did on the floor before, where like you just make the market. It's more like, hey, I know like Jeppy's got to sell however many million Vega on this week. It's like they're gonna lower, like all those markets are gonna be lean lower starting days in advance. And like this was not, if you have a chance, if you can make markets, you are leaning. You're like, I am a seller of Vega for like the 4 days leading up to that, because I know there's this giant supply of Vega, and I know how much the market can absorb. Like I know how many I have some guess as to how many vol points all that Vega has to move the market. So like if I'm like, by the end of this week, I think vol is low, all else equal, like vol is lower 5 points, like in expectancy, then I can I can lower my vols. Like I'm selling vol 1 vol cheaper, 2 vols cheaper, knowing I'm going to get resupplied 5 vols cheaper. So this is, I call it setting the table. So they're setting the table against the counterparty days in advance, because there's not going to be enough to just like lean the market on that day. And then when the counterparty comes in and sells all those options, they get filled like mid-market. If you were like a naive observer, you'd be like, how did the market take down all these options at mid? Like, how did it absorb all that Vega at mid? It's like, well, it did that because it knows that that's a fake price. It knows that they are not really sellers down there. And it's like the market is, 65, 68, but there's really not much on the 68 offer, and there's a lot on the 65 bid. So when they come in offered at 67, it's like gobble, gobble, gobble. That's what we were all waiting for. They buy it all up, and then they're going to walk it, and then they're going to walk it back up. Right. So this is, anyway, that's kind of like trading, a little bit of like how trading actually works. And then, I don't know, maybe a little bit of a warning about like, when you're thinking about anything that's ever being traded, like where are you in the information hierarchy? What do you, do you know, to what extent, are you being fooled by somebody else's, lean, or not knowing what the real side of this market is. That's all. Anyway, that's what the tweet was about. So, cool. Thanks for helping me procrastinate.